Hello, today we're here with Ran Neuner. We're going to talk a little bit about the crypto treasury company hype that is going on across the world right now. Back in 2020, MicroStrategy started buying Bitcoin. It made the news. Tesla also made some Bitcoin purchases. But now all sorts of things are popping up, from cannabis companies buying Dogecoin to all sorts of crazy stuff. Ran, what is going on? We all know something crazy is going to happen.
So, let's just understand the playbook. You mentioned correctly that MicroStrategy started something. And what they started was they created a playbook for equity companies, for listed stocks, to be able to raise money to land up buying tokens. And what MicroStrategy did was they created the playbook using Bitcoin, right? So Michael Saylor created a vehicle. And what this vehicle did was it leveraged capital markets outside of crypto and used the proceeds from what it managed to raise to buy a token. And that token was Bitcoin. And what MicroStrategy proved through incredible returns was that this is a very attractive playbook, and this is a very easy way and a very attractive way to access markets that traditionally crypto couldn't access. Because if you think about crypto in the previous cycles, crypto was money that came into crypto via USDT and maybe USDC, and then people would use those proceeds to actually buy crypto. What Michael Saylor did was he said, well, hold on, how do you get access to capital markets, which are much bigger than crypto? Like, crypto is a $3 or $4 trillion market, and capital markets are 60, 70, 80 trillion dollars, depending on how you look at it. And what Michael Saylor did very successfully was he created a playbook to do it using both debt and equity finance. And so effectively, what he managed to do was to tap equity markets to be able to raise equity finance to buy Bitcoin. And he was able to tap debt markets to also create convertible notes and related items, so that now all of a sudden, in an environment where interest rates were dropping, he could provide fixed income investors or debt investors with a way to access increased returns through crypto. And that was the Michael Saylor playbook.
And I kind of get the Michael Saylor playbook, right? Because he also has a company that is making revenue. So if you're a debt investor, you're thinking to yourself, okay, this Bitcoin thing might not work out, but at least I know that this business is worth something and generates some sort of cash flow. I kind of get that part. Oh, no. Okay. Tell me more about what this capital markets
I don't think so.
Why were they interested?
So I think the capital markets wanted access to Bitcoin. Remember, at the time, there were no ETFs.
No ETF, yeah.
And the only way they could get access to capital markets, the only way capital markets could get mass exposure to Bitcoin was through a MicroStrategy type vehicle, right?
Yeah.
And for debt holders, for fixed income investors or for debt investors, they could never have access to crypto. And in an environment where the interest rate is dropping from, say, 5% to 4% and 3%, and we're expecting rate cuts this year, then it becomes quite hard to be a fixed income investor, because your rates are going down a lot. Your yields are going down a hell of a lot. So what's the play? Well, the play is to invest in something that's more risky. The problem is that your mandate doesn't allow you to do that. And what Michael Saylor did very, very, very smartly was he said, hold on, let me create a debt instrument which converts into equity, which people can sell and realize the returns if Bitcoin actually goes up. And that gave fixed income investors access to crypto. Now let's fast forward. So Michael Saylor proves the playbook, and
but as you mentioned, like, a lot of things changed since then, right? You got the Bitcoin ETF. He became a de facto Bitcoin ETF at the beginning, but now there's dozens of Bitcoin ETFs. There's a lot of places for institutional investors to get crypto exposure, and yet the hype continues. What is happening?
Okay, so you said it. How does a institutional investor get access to leveraged Bitcoin returns? Right now, they can buy spot Bitcoin returns through the ETF, right? But if they want something a little bit more exotic and something that reacts with a little bit more volatility, their option is really only to go into something like similar to a MicroStrategy. Why? Because MicroStrategy is tapping fixed income returns for its fixed income for its debt holders, and the equity owners land up getting leveraged upside. And that's pretty much the MicroStrategy play, which means that in a bull market, MicroStrategy performs really well. And in a bear market, MicroStrategy performs really poorly, right? Because it's a leveraged bet on Bitcoin.
Of course.
All right, now let's fast forward a bit later. So a couple of things happened in quick succession. The first thing that happened was Circle listed on the NASDAQ, right? And when Circle listed on the NASDAQ, it obliterated any kind of returns that anyone could have expected. People expected Circle to come on at a $5 or $6 billion valuation. And if I'm not mistaken, it came on at like 10 times that or something like that.
Yeah.
What that did was it gave Wall Street a taste of the returns that we're kind of used to in crypto. You know, in Wall Street, they're not really used to a 10x or a 20x. In crypto, it's like kind of becomes, like we're kind of used to it. But in Wall Street, it got them listening. And then Joe Lubin.
So Circle came out, Circle pumped, and there was just a lot of latent demand for crypto assets on the stock market. So this is demand maybe from capital markets, maybe from institutional investors, maybe from retail investors that are looking at Circle and saying, hey, I want to get into this crypto game.
It doesn't matter where the demand came from. What matters is that the price went parabolic. And that was the best form of marketing and the best way to attract attention for this crypto thing. At exactly the same time, the Genius Act and all of those things started falling into place. The regulation started to be very favorable. Therefore, Coinbase started to run and Robinhood started to run. And so you got like these parabolic returns in anything to do with crypto on the stock markets. And then came the kicker. And the kicker was Joe Lubin, the co-founder of Ethereum and the founder of Consensus, very big name in the ETH ecosystem. Yeah. He launched a ETH treasury company, an ETH version of MicroStrategy called SharpLink or SBET.
Yes.
And
SBET.
The SBET price went parabolic, right? About a week or two later, Tommy Lee, who's very well known from Fundstrat, he's a very astute investor and a contributor on CNBC, he announced that he's the chairman of BMNR, which is another ETH version of MicroStrategy. And so what landed up happening was now the market, and all of these, as these announcements happened, all of a sudden the prices went parabolic. And I think SharpLink did like a 50x, if I'm not mistaken. And let me actually quickly just call up the numbers here so we get the right numbers here. So SBET went, I'm going to call up the charts. If I take the bottom just before the announcement and I go all the way up the top, it did a 6,000% return. And I think BMNR was pretty similar. Like if I look at BMNR on my ticker here, that one did a 3,000% return. And so now Wall Street's looking at these things and going, hold on a second. If these companies, which are...
Yeah, so I kind of get MicroStrategy. This is back in 2020, pre-Bitcoin ETF, pre-Ethereum ETF, but there's an Ethereum ETF already. Why is SBET, and the other company, why are they pumping so hard? Are people being conditioned by MicroStrategy to think, oh, wow, this is really going to go up? Who's buying this? Who's pushing this
Two reasons.
Forward?
First of all, the fundamental reason is, again, the ETF is a 1-to-1. For every dollar that you put into an ETF, one Bitcoin gets bought. The equity in these companies is actually leveraged because they're a combination of debt and equity finance, right?
Yeah.
And debt holders require a much smaller return than equity holders, which means that the equity holders land up getting most of the return with debt holders' money. It's a pretty old Wall Street playbook. Also, sometimes it's about a narrative. And right now, the hot narrative is crypto. And these guys are riding the hot narrative. Now, this is where the danger comes in. So let's just understand what's happening. These companies, which are zombie companies, they're pretty dead. Most of them are in, as you say, cannabis or biokinetic or biomedicine or pharmaceuticals or whatever else. Most of these companies are dead or dying. And in order to pivot, what they're doing is they're being taken over. And I use the word taken over quite loosely because in terms of SEC regulations, they're not actually getting taken over. But they are pivoting to become ETH treasury companies or hyperliquid treasury companies or BNB treasury companies. And what Wall Street is saying is, hold on a second, did you see what happened when SBET did that? Did you see what happened when BNMR did that? And everybody wants a piece of the next treasury company. And so every time that a treasury company is announced, all of a sudden the stock price starts to fly. Now, how high does the stock price go? The stock price typically trades at between 2 and sometimes even up to 10 times the net asset value of the company. Okay, this is where the danger comes in. As soon as these guys make the announcement and they make an announcement and they start buying ETH, just like when Michael Saylor started buying Bitcoin, these companies started trading at a big premium to the net asset value on the books of the company. Now, anything between net asset value and what people are paying is effectively considered leverage, right? Yeah. So like the concept of leverage is effectively the concept of making money that doesn't really exist. That's the concept of leverage, right? And anything
that's
about
the speculative demand there, right? Like that's the people saying, okay, this company could be worth more because someone's going to buy it off me for more money.
Yes, but in this case, the speculative demand is a result of leverage because what they're saying is it's going to be a combination of debt and equity. And because there's debt in the vehicle, that value is what you call the leverage gap, right? So the difference between NAV, the net asset, because theoretically, these things should trade like the ETF at net asset value.
Exactly.
The ETF never ever trades above or below net asset value, because theoretically you could just redeem a share for the net asset value. These companies are trading at 2 and 3 and 4 times the NAV. And the difference is they're relying on the leverage component of it. In other words, how much debt can they raise? How much can they leverage these vehicles, right? In order to achieve a return. And that's why MicroStrategy in the bull market trades at a big multiple to NAV and a big premium to NAV. But in the bear market, actually went to a discount to net asset value, right? Okay. And that's a function of bull markets and bear markets. So the difference between the net asset value and the price that people are paying is how much leverage is in the system. Now, every crypto cycle ends, or every cycle ends, because there's fake money in the system, there's leverage in the system. In the crypto cycle of 2017, there was fake ICO money in the system. It was people that were sending 1 ETH to an address and getting 100x back in these play tokens. And then eventually that collapsed. In 2021, the cycle was fueled by this fake money called Luna, which actually didn't really exist. It was an algorithmic stablecoin. And when that leverage...
Lots of fake money in FTX as well.
Exactly. But actually FTX imploded because Luna imploded. Because if Luna hadn't imploded, none of the other tokens would have imploded, right? And what we realized is that FTX was leveraged, Luna was leveraged, Celsius was leveraged, Genesis was leveraged. Everyone was actually leveraged. And when the bubble popped, the leverage collapsed. In the 2008 crisis, what we realized is that people took too much leverage. And then one little pin popped the leverage bubble and all the markets collapsed. Where is my concern here? My concern is that what we're creating here is we're creating a leverage bubble. And the leverage bubble is retail and institutional investors who are buying leveraged crypto. That's really what they're buying. They're buying leveraged crypto. Instead of going to buy Bitcoin and ETH on Coinbase, or even just buying the ETFs, they are buying leveraged crypto. And they're not buying it on small numbers. They're buying it with an $80 trillion capital markets checkbook. And what they're buying is they're buying a little bit of assets and they're buying a lot of hot air, which is the promise of the difference between the debt and the leverage. That is a very, very, very scary thing. Because as more and more of these companies come into the market, so more and more leverage builds up. And you know what happens when leverage collapses? It's all good and well when things are running. But as soon as the markets start going down, what's going to end up happening is these guys are not going to have diamond hands and they're going to start collapsing. As they start collapsing, they're going to start selling off the ETH that they're actually holding, right? And as they do that, so the market's going to come down and more of these companies are going to trade at under net asset value. And eventually it's going to be like a whole lot of dominoes just collapsing and all of these guys selling their crypto into the market. That's the first part of it. And that is one of the scary parts of this. In fact, that's the very scary part. The very scary part is we're building up a whole lot of leverage, and leverage in a system is really bad. It's unhealthy. I mean, a good amount of leverage is healthy, but here we're getting into 3, 4, I've seen some 10 and 12 times net asset value. Can you imagine buying an ETH vehicle at 10 times the net asset value?
You're basically buying $1 of ETH for $10.
Exactly. Can you imagine? You're paying $35,000 for an ETH now, where you can just go and buy it at whatever the price is today on Coinbase.
You're creating because you're hoping that someone's going to buy it from you at an even higher price.
Correct. And eventually, and we know that's not going to happen because we know what the value of the underlying asset is, and we kind of know what the value of the debt is as well, right? So this bubble's forming. And unfortunately, it's not a very small bubble, like a contained bubble, within a $3 to $4 trillion ecosystem called crypto. This time, it's actually being accessed by the capital markets. And so problem is,
it could have an impact on global capital markets?
I think it can. I think certainly it can have an impact on the US market because the majority of these are listed on the US market. And the majority of these are not actually, or the new projects which are being launched are not actually being based on Bitcoin, but they're moving down the risk curve to things like Ethereum, things like BNB, things like Sui, things like Ton, Hyperliquid, Tau. On Bitcoin, I can kind of say, the asset's kind of proven. It's maybe a new kind of gold. If you want to put that onto as a treasury company, I can kind of understand that. But when you move lower down the risk curve, these are still protocols that are in experimentation stage. And we're building layers and layers and layers of leverage on these protocols. And no matter which way you look at it, that can't end well. There's just no way in hell that it can end well. Now I'm going to show you the next part of this thing. So in every market, you kind of have to ask yourself, who's the buyer and who's the seller? because that's how you understand market dynamics. So we've been involved in quite a few of these treasury companies. What we've realized is that this is actually a very, very, very smart way for crypto native people to make a whole lot of money out of TradFi native markets. It's the craziest thing you'll ever hear. And I think I'm going to blow your mind here when I tell you this. Imagine I come to you and I say to you, Boaz, do you have any ETH? And you say to me, yeah, I've got 10 ETH. And I said to you, great. Why don't you give me those 10 ETH, which is valued at $35,000 today, and I give you $35,000 of shares in my new company, okay? You say, okay, that's not a bad deal, but why would I do it? And I say to you, well, Boaz, because as soon as we announce to the market that this company is an ETH treasury company, the shares that you got at net asset value are going to be worth 3 times net asset value. What's your reaction?
Sounds great. Easy way to 3x my money.
And what are you going to do?
If I'm Joseph Lubin, I've got billions of dollars in ETH, and selling it would impact the market, this would be very attractive.
Sell it to yourself. So here's the catch. You, Boaz, I go to you and I say to you, Boaz, we're starting this new vehicle. Do you have any ETH? And you say, yes, I'm a crypto native investor. I have ETH. And I say, well, give me your ETH and I'll give you 3 times back the value of your ETH. I'll give you shares at net asset value. And right now, the vehicles are trading at 2 and 3 and 4 times net asset value. Okay? So what do? You say yes. You get your shares. And the first thing you do is you sell some of your shares to retail and you recoup your ETH. And you're still left with 2x returns in the share.
Yeah.
Okay?
It's
Genius.
Crazy.
Genius.
And if I wanted to sell my ETH, if I'm moving billions and billions of dollars, maybe it would cost me a lot in terms of slippage, in terms of moving the market against me, etc. This way, I'm selling it to myself and I get to keep the money.
So if you read all these announcements, like for example, SharpLink for me is the best one. Because what it says is they raised X amount of money, $500 million of money, whatever the number is. But then you look at who the contributors are. It's Arrington Capital, Electric Capital, Republic, Pantera. They all have ETH. They all have ETH. So all they're doing is they're putting their ETH in the vehicle. They're getting the shares. They're getting shares at net asset value. The shares are opening at 20 times net asset value. They're cashing out their original investment. And they've got 19 times or 10 times or whatever the number is in shares free. So it's a way that crypto native investors are making money out of non-crypto investors, right? The greater fool buying their tokens. Now, let me give you the last cherry on top, because now you've seen how we're building a leverage bubble, and now you've also seen how crypto native people are getting their money. Now I'll give you the last part of it. A lot of crypto gains from a lot of crypto OGs were made, shall we say, before the time that it was like that people really understood how crypto worked. Like if you think about a lot of the ETH OGs and you ask them, how did you buy your ETH? Quite hard. Like a lot of that money is not really declared, and what was the tax? This way, you've basically laundered all your money. Why? Because you give it to a listed vehicle as an investment. You're getting shares back. The shares are pretty legit. The shares are shares in your name. So you got like a triple whammy here. Because
also no capital gains on your crypto transaction
because you're not selling it. Exactly.
No, you're swapping it for the exact same value.
Exactly. It's exactly that. It's an in-kind swap of a thing for a share. So I don't know which countries, what the law is in each country, but in most countries, that's permitted. You're taking, because now you don't own the dirty ETH or the dirty BNB or the dirty whatever it is anymore. You own clean shares, which are registered with the SEC and are effectively, if you want to call it, clean money, right? So what you've got is the ultimate machine here, which cleans money, gives you a multiple on your ETH and creates a massive leverage bubble. So what I believe happens? I think right now markets are running, rates are going to start coming down, markets are really hot, and markets are in full-on risk mode. And so they're looking to buy anything that they can. But you know how it works. One little crack, and then one of these treasury companies comes down, and then people start questioning themselves. I don't know if you remember, but before the ETFs, there was a product called GBTC.
Yes,
and GBTC was where people used to pay 100% premium to buy Bitcoin. It was crazy. It was ludicrous.
I mean, wasn't that a big part of the whole Luna story as well? The GBTC arb falling apart.
Correct. And what happened is then GBTC went from 100% premium to a 50% discount. Did you remember that?
Yeah.
That's happening all over again. That is exactly what's happening all over again. So what is the smart money doing? Smart money, number one, I don't know if I'd be buying a lot of these tokens on the open market, a lot of these shares on the open market, because you got to think to yourself, who is your buyer? I know, who's buying from the crypto native people, but I can't think of who would be buying it from you, right? From the next buyer.
Yeah.
Number two, keep some cash in hand, because when this thing falls, it's going to fall really hard. And what you're going to be able to do is you're going to be able to pick up a lot of these treasury companies at under net asset value, which is a big, which is going to be a very, very, very big win. I think we're in the early stages of a bubble, but remember, bubbles pop way before anyone expects them to pop. I think we've probably I think what's going to happen is we're going to have a couple of months where these treasury companies are going to get a premium. Then the first few are going to launch without a premium. And then people are going to start questioning this whole model. And then only the best treasury companies, the micro strategy, one or two of the best in each pedigree, is going to be the one that actually survives. And I think that's how it plays out.
So I think this is super interesting because it also explains why crypto prices haven't really risen that much, right? Okay, MicroStrategy is exactly, no one's actually buying. All of the money it's not taking ETH or Bitcoin or anything off the market. It's just taking money that people coins that were held already and being swapped, and you're selling the shares.
You got it. Simple.
And who's going to be left holding the bag here? Because if I'm a multimillionaire
retail shareholders who are buying something that you can buy in the open market for $1 and they're buying it for up to $3 or $4. It's a very simple bubble. And there's no way, one of my mentors in the space once said to me, I once asked him, I said to him, did you invest in Luna? And he said, I didn't invest in Luna. I said, why? I said, because I don't believe in anything that creates excess leverage in a system, and Luna is excess leverage. Here, what we're doing is we're creating excess leverage into a system. We're not really adding any value. Or maybe we are by combining debt and equity, but there's no way that value is equal to the crazy and ridiculous premiums that these companies are providing. And in the absence of that, I think that there's no only logical next step is that the leverage bubble lands up bursting. I hate to say it, but the sooner it lands up bursting, the better, because the longer it takes, the more leverage will be built up, the bigger this bubble, the bigger the smack may actually be.
And what's going through the mind of the retail investors that are buying these company shares? Are they thinking, wow, MicroStrategy ran so hard, so all these other ones are going to run too? Is that why this narrative has come up? Because usually retail investors would hop on Coinbase and buy the latest shitcoin. But now, for some reason, they're going to brokerage accounts.
Problem is you've missed that run. Imagine you've seen MicroStrategy, and MicroStrategy has gone from nowhere to $450 or $460. You missed that. And you missed Coinbase at $30 or $40, and Coinbase is also at $400. And so now you're asking yourself, you're seeing all these crazy returns, and you're saying to yourself, well, how do I get some of these crazy returns? And so what do? You do what people do at the top of most cycles. And that is you look for anything that promises you to bring the risk. Just think about how crypto cycles land up ending, right? So what happens is we all invest in Bitcoin. And then we say, okay, we've got enough returns from Bitcoin. We're not going to get great returns. And then we go to ETH. And then we're like, okay, but now we go down to Sol. And then we land up in like the worst shitcoins at the end of the cycle because we're looking for amazing returns. That's exactly what's happening here. Markets are at all-time highs. Investors missed NVIDIA. They missed Tesla. They missed Amazon. They missed Microsoft. They missed all of those. And they're saying, where can I get the returns like this? I missed Robinhood. I missed SoFi. Where can I get the returns? Well, you can get them in crypto. Okay, well, throw money at crypto. It's a frenzy. Throw money.
And this is, as you mentioned, right now, primarily a U.S. markets thing, right? It's primarily American retail investors who are going after these crypto treasury companies in the hope that they'll cash the next MicroStrategy.
That's exactly what it is.
Yeah, this is a crazy story. It also explains why crypto markets, Bitcoin 120 is great, but ETH hasn't even seen its all-time high, right?
Well, who's buying?
Exactly.
No one's buying. The ETFs are buying. I'll give it to you. The ETFs are buying. But otherwise, all these fancy, shiny treasury companies. The other day, we had an announcement that Founders Fund was, joined BMNMR. But Founders Fund have got a ton of ETH. It's no surprise. Yeah. Come on. Any investor where he's told he can cash in his ETH for ETH at a premium is going to do it. I mean,
of course.
You don't have to be a genius.
Why wouldn't you?
You don't have to be a genius.
Yeah. Ran, thank you so much for highlighting this story. Is there anything else that you'd like to add?
Yeah, I mean, I think you pretty much got it. I saw that you had the penny drop moment where you just realized that this is like the ultimate machine.
Yeah. Yeah, I mean, this is a great deal for you if you've got millions and millions of dollars of old ETH that you bought off God knows what website without checking who your counterparty was, which would be very, very difficult to explain to a regulator where you got it from, how you sold it, etc., etc. And maybe if it came out that, crypto OGs are selling crypto, then it would look quite bad, right? But this way, you're just investing in the treasury company. Very exciting, very, very interesting.
You're exiting a market without actually selling your tokens. What a brilliant deal.
And you get to sell at all-time highs. Why not do that? You've been sat in Bitcoin for 7 years, 10 years.
You got it.
You want to take some profits.
You got it.
Exactly. All right, Ran, thank you very much for explaining crypto treasury companies to me. I'm looking forward to seeing what happens. Hopefully this bubble pops sooner rather than later. But by the sounds of it, we might only just be now getting started.
Look, there is a good part of it. Just quickly, there is a good part of it. The good part of it is that eventually they will land up buying. They will raise debt and they will tap debt markets to actually start buying crypto. So I don't think it's a net zero game. I do think it introduces a lot of marginal buyers, but I don't think it justifies the increase in leverage that's currently happening in the markets. And that's the part that worries me.
Yeah, and thank you so much for bringing attention to this, because we all want to avoid the next Luna and the next GBTC
Exactly.
and, ICO phase, etc., etc. Ran, thank you very much.
Cool, man.